Today we're looking at the decentralized finance deception. Okay? The question is this: why has DeFi become a systematic Ponzi scheme evolution instead of financial democratization? And why does this system create sophisticated fraud mechanisms through yield, farming and liquidity mining that extract wealth from retail investors, while enriching early adopters through mathematical manipulation disguised as financial innovation? Okay? We've done extensive research and discovered that decentralized finance isn't designed for financial inclusion. It's designed to create modern Ponzi schemes that use blockchain technology, complex mathematical formulas, to disguise wealth extraction from late investors, while generating profits for protocol creators and early participants. Most people think DeFi represents financial innovation that democratizes access to banking services, lending protocols, and investment opportunities through blockchain technology that eliminates traditional financial intermediaries. Revolutionary system that provides higher yields, transparent transactions, and permissionless financial access that empowers individual investors and creates more equitable financial systems. Technological advancement that uses smart contracts and algorithmic protocols to provide better financial services than traditional banking institutions. But that's not what this is about. This is about the systematic evolution of Ponzi schemes into technologically sophisticated fraud systems that use complex protocols, yield farming mechanisms, and liquidity mining programs to extract wealth from retail investors while creating the illusion of sustainable returns through mathematical manipulation disguised as decentralized innovation. Let me tell you what the research reveals. DeFi protocols promise annual yields of 15 to 4,000%, while 94% of projects experience total value collapse within 18 months of launch. Retail investors have lost $12.7 billion to DeFi protocol failures, rug pulls, and Ponzi collapses, while protocol creators and early investors extract an average of 73% of total deposited funds before projects fail. Meanwhile, only 3% of DeFi users understand the mathematical mechanisms that determine yield generation, while 89% believe their returns come from legitimate business activities rather than new investor deposits. This isn't financial innovation failure, this is sophisticated fraud evolution success. Here's what's really happening. The cryptocurrency industry discovered that traditional Ponzi schemes are easily recognizable and legally prosecuted. But blockchain technology enables fraud complexity that obscures wealth extraction mechanisms while providing legal protection through regulatory uncertainty. Once investors understand they're participating in Ponzi schemes, they typically withdraw investments and report fraud to authorities. But if you can disguise wealth extraction through complex mathematical protocols and decentralized terminology, you create investors who participate in sophisticated fraud while believing they're using legitimate financial innovation. The business model is sophisticated. Unlike traditional Ponzi schemes that promise fixed returns from fictitious business activities, DeFi protocols use algorithmic yield farming, liquidity mining, and token emission schedules that disguise new investor dependency while providing mathematical complexity that prevents fraud recognition. Protocol creators generate profits from token pre-mining, developer fees, and early exit strategies that extract wealth before protocol collapse. Yield farmers benefit from unsustainable token emissions that reward early participants at the expense of late investors. The entire system depends on continuous new investor recruitment to maintain yield payments, not legitimate business revenue or sustainable economic activity. This isn't accidental protocol failure. This is deliberate fraud evolution, using techniques borrowed from traditional Ponzi schemes but disguised through blockchain complexity and financial engineering. Token emission mechanics that front-load rewards for early investors while creating unsustainable yield obligations for late participants. Liquidity mining programs that require continuous new capital injection to maintain promised returns. Smart contract complexity that prevents most users from understanding the mathematical impossibility of sustained yield generation. The research shows that DeFi users dramatically underestimate the Ponzi mechanics underlying yield farming protocols and overestimate the sustainability of returns generated through token emissions and liquidity mining. People aren't participating in DeFi because it provides legitimate financial services or sustainable investment returns. They're participating because protocol creators have learned to disguise traditional Ponzi schemes through technological complexity that makes fraud recognition impossible for non-technical users. Consider how DeFi wealth extraction actually operates in practice. Instead of generating yields through legitimate business activities or productive economic investment, protocols promise returns through token emission schedules that reward current participants using funds deposited by future investors. This creates mathematical dependency on continuous new investor recruitment while generating unsustainable yield obligations that require protocol expansion or collapse. But here's the crucial point: Token emission creates wealth extraction rather than wealth generation. DeFi participants feel pressure to maximize yields through complex farming strategies that involve multiple protocol interactions and token staking mechanisms. They deposit funds into liquidity pools that promise high returns through token emission rewards and trading fee sharing. They participate in yield farming strategies that require continuous protocol monitoring and optimization to maintain promised returns. They reinvest yields into additional protocols to compound returns while increasing exposure to protocol failure and rug pull risks. The DeFi system creates artificial yield opportunities that wouldn't exist without new investor fund injection and mathematical manipulation designed to extract wealth from late participants. This is why DeFi often creates more financially exposed but not wealthier participants. Users understand they're earning high yields through sophisticated protocols, but realize their returns depend on protocol sustainability and continuous new investor participation. They know they're participating in experimental financial systems, but face mathematical complexity that prevents understanding of underlying Ponzi mechanics. They want financial independence, but encounter protocol risks that threaten total capital loss through smart contract failures and rug pull exits. The institutional adoption amplified these dynamics exponentially. While traditional Ponzi schemes operated at small scales with limited investor pools, DeFi protocols integrate institutional capital and celebrity endorsements that create legitimacy perception while enabling larger-scale wealth extraction through protocol complexity and regulatory uncertainty. The financial democratization narrative provides perfect cover for this fraud evolution. Even though mathematical analysis proves most DeFi yields require continuous new investor recruitment rather than legitimate business revenue generation. But the narrative justified both protocol participation and acceptance of extreme risks by suggesting that blockchain technology enables superior financial services and investment returns through decentralized innovation and traditional banking disruption. This business model obscures the reality that sustainable financial returns require legitimate business activities and productive economic investment, rather than mathematical manipulation and new investor wealth extraction. Instead of creating genuine financial innovation, DeFi protocols encourage speculation and fraud participation that generate short-term returns for early investors while creating inevitable losses for late participants when mathematical sustainability failures cause protocol collapse. The yield farming industry represents the ultimate expression of this fraud sophistication. Liquidity mining protocols, governance token distributions, and algorithmic stablecoin systems suggest that high yields result from innovative financial engineering, rather than traditional Ponzi mechanics disguised through blockchain complexity. This framework transforms Ponzi scheme participation into financial innovation while creating revenue streams for protocol creators who extract wealth through token pre-mining and early exit strategies. But research on DeFi sustainability shows that protocols with legitimate business models and sustainable yield generation achieve significantly lower returns than those using token, emission, and new investor dependency mechanics. Yet unsustainable yield farming has become the dominant DeFi approach because it generates maximum short-term returns and investor attraction regardless of long-term protocol viability or investor protection. The protocol dependency itself becomes a recognized investment phenomenon. Users develop psychological attachment to yield farming that prevents them from recognizing mathematical unsustainability and Ponzi mechanics. They become financially dependent on protocol yields and emotionally invested in DeFi success stories that interfere with fraud recognition and risk assessment. The protocol relationship crowds out traditional investment analysis, due diligence, and fraud awareness that would identify Ponzi schemes regardless of technological sophistication. This creates what financial researchers call technological fraud blindness, investment behavior caused by blockchain complexity that prevents recognition of traditional fraud mechanisms disguised through smart contracts and mathematical protocols. DeFi, designed to democratize financial access, creates people who participate in sophisticated Ponzi schemes while believing they're using legitimate financial innovation. Technology intended to eliminate financial intermediaries creates dependency on protocol creators who extract wealth through mathematical manipulation and early exit strategies. But the industry protects itself from criticism by pathologizing resistance to DeFi participation. If someone questions protocol sustainability or yield generation mechanisms, they're exhibiting technological conservatism that prevents financial innovation adoption. If they prefer traditional investments over yield farming protocols, they're showing DeFi resistance that misses revolutionary financial opportunities. Criticism of protocol mechanics becomes evidence of blockchain ignorance requiring education about decentralized finance benefits and traditional banking limitations. The most sophisticated manipulation involves reframing Ponzi schemes as financial innovation. Unsustainable yield generation is marketed as algorithmic finance rather than mathematical impossibility, disguised through token emission. New investor dependency is promoted as liquidity mining, rather than traditional Ponzi mechanics using blockchain technology. The innovation framing bypasses fraud analysis that would recognize DeFi as sophisticated scams rather than legitimate financial advancement. The cultural effects extend beyond individual investment decisions. Society has become financially dependent on speculative technology, while accepting extreme investment risks as normal innovation adoption. Traditional due diligence and fraud recognition are seen as technological resistance rather than necessary investor protection. Ordinary investment caution is viewed as limiting compared to DeFi participation rather than prudent financial planning. Natural skepticism about unsustainable returns is categorized as innovation resistance rather than fraud awareness that protects against wealth extraction schemes. This DeFi colonization of investment behavior undermines traditional fraud recognition and investor protection mechanisms. Participants invest in mathematically unsustainable protocols rather than developing traditional investment analysis and due diligence skills. Communities promote yield farming and protocol participation rather than supporting fraud education and investor protection that create financial security. Educational institutions teach blockchain technology without emphasizing fraud recognition and Ponzi scheme identification that protect against sophisticated financial manipulation. The financial system has been infiltrated by DeFi ideology that treats technological complexity as innovation proof and mathematical manipulation as algorithmic finance. Investment advisors recommend protocol participation rather than traditional fraud analysis and due diligence that protect investor capital. Investors learn to optimize yield farming strategies rather than developing fraud recognition and risk assessment capabilities that identify Ponzi schemes regardless of technological disguise. Even cryptocurrency advocacy and blockchain education movements promote DeFi thinking through protocol analysis rather than fraud recognition and Ponzi scheme awareness that would identify Ponzi mathematical manipulation disguised as financial innovation. Financial education emphasizes yield optimization and protocol interaction rather than traditional fraud analysis and investor protection that prevent wealth extraction through sophistication technological schemes. This DeFi colonization generates enormous wealth extraction while systematically destroying investor fraud recognition capacity, due diligence skills, and financial protection through technological complexity that disguises traditional Ponzi mechanics. The decentralized finance economy has successfully convinced people that blockchain complexity indicates innovation legitimacy, creating a generation of sophisticated fraud participants rather than protected investors who recognize mathematical manipulation regardless of technological presentation. The most insidious aspect is how this system disguises wealth extraction as technological advancement. Investors are told they're participating in financial innovation through DeFi protocols, but they're actually funding sophisticated Ponzi schemes that use blockchain technology to disguise new investor dependency while extracting wealth through mathematical manipulation and early exit strategies. They're encouraged to think about yield optimization while being discouraged from recognizing that protocol mechanics often represent traditional fraud schemes enhanced through technological complexity. The research shows that investment approaches focused on traditional due diligence, fraud recognition, and sustainable business model analysis often achieve better long-term wealth preservation than those emphasizing DeFi participation and yield farming optimization. But this evidence is suppressed or reinterpreted through frameworks that protect the DeFi industry's wealth extraction and fraud evolution agenda. Think about the economic incentives. An investment system that emphasizes traditional due diligence and fraud recognition limits participation in unsustainable protocols and reduces wealth extraction opportunities for protocol creators. A system that promotes technological complexity and yield optimization maximizes investor participation in sophisticated Ponzi schemes regardless of mathematical sustainability or investor protection. Which approach do you think gets supported by protocol development, DeFi marketing, and blockchain industry promotion? The DeFi economy has created a society of technologically sophisticated but financially exploited investors who can navigate complex protocols but can't recognize traditional fraud mechanics, understand blockchain technology but lack fraud awareness, participate in algorithmic finance but build no protection against mathematical manipulation disguised as innovation. This isn't financial democratization. This is systematic fraud evolution disguised as technological advancement. The DeFi industry profits by converting traditional fraud recognition into technological complexity while extracting wealth from retail investors through sophisticated Ponzi schemes that use blockchain technology to disguise mathematical manipulation and new investor dependency. But perhaps most damaging is how this system has convinced an entire generation that technological complexity indicates investment legitimacy, rather than recognizing that DeFi often represents fraud. Evolution designed to disguise traditional Ponzi schemes through blockchain sophistication, while extracting wealth from late investors who cannot recognize mathematical manipulation disguised as financial innovation. People struggling with DeFi protocol losses, inability to understand yield generation mechanisms, and realization that promised returns require continuous new investor recruitment are told they need better protocol analysis and blockchain education, rather than recognizing they're experiencing sophisticated fraud designed to disguise traditional Ponzi mechanics through technological complexity. The DeFi industry profits by treating symptoms of fraud participation as educational deficiencies requiring additional protocol understanding rather than fraud recognition and investor protection. Consider what happens when someone realizes their DeFi yields depend entirely on new investor deposits and token emission rather than legitimate business revenue, while protocol creators have extracted millions through pre-mining and early exits before inevitable protocol collapse. Traditional investment advice focuses on better protocol selection and yield optimization rather than recognizing the systematic fraud evolution designed to extract wealth through technological complexity. This DeFi normalization of sophisticated fraud serves powerful protocol creation interests. Instead of questioning financial systems that profit through mathematical manipulation and new investor exploitation, people focus on optimizing their farming strategies rather than recognizing the traditional Ponzi mechanics disguised through blockchain technology and algorithmic complexity. The DeFi economy has successfully convinced people that their protocol losses indicate insufficient technological understanding rather than systematic fraud participation through blockchain-disguised Ponzi schemes. That their inability to sustain yields reflects inadequate farming strategy rather than mathematical impossibility of promised returns. That they need protocol education rather than fraud recognition and traditional investment protection. The ultimate irony is that DeFi creates the very financial losses and investor exploitation it claims to prevent through traditional banking disruption. By disguising traditional fraud through technological complexity, it enables wealth extraction schemes that surpass traditional financial institution exploitation through mathematical manipulation and investor protection elimination. The end result is a population of technologically educated but financially exploited investors who can interact with smart contracts but can't recognize fraud mechanics, understand algorithmic finance but lack investor protection, participate in decentralized protocols but build no defense against mathematical manipulation and wealth extraction disguised as financial innovation. The DeFi economy has succeeded in convincing people that technological complexity indicates innovation legitimacy, that mathematical algorithms represent sustainable finance, and that blockchain technology eliminates fraud risk. It has monetized fraud evolution, commercialized Ponzi sophistication, and transformed investor protection into technological resistance, while enabling wealth extraction schemes that surpass traditional financial fraud through complexity and regulatory uncertainty. And this system will continue expanding because fraud sophistication generates higher returns than legitimate business, while technological complexity provides legal protection and investor confusion, that enables wealth extraction without traditional fraud prosecution. Does that make sense, guys?